So welcome. Today we cover a topic called financial instrument. That's IFRS 9. So let me define what's a financial instrument. And a financial instrument is just a contract which gives rise to an asset to one party and a liability to another party. That's what we call a financial instrument. So let's write something. We are saying that financial instrument, it's a contract which gives rise or which gives is a contract which gives rise to an asset to one party and a liability to the other party. E.g., for example, assume we have a loan, a bond, bank or cash at bank. For example, if you have a bond, if the company issues a bond, now to the company that bond becomes a liability, but the person who acquires that bond or the bond holder becomes an asset. If you take your cash to the bank, that means to the bank that amount is a liability because that amount does not belong to the bank. It will belong to the client. But to you, it's an asset. Now that's what we call a financial instrument. It's giving rise to an asset to one party and a liability to another party. Even equity or the shares. If the company issues shares, you buy the share, you become the shareholder. So that means to you it's an asset, but to the company it's a liability. Good. So now let's start with financial asset. Financial asset. We are saying that you can give rise to a financial asset to one party or a financial liability to another party. So we start with the financial asset. And what's a financial asset? Now a financial asset, this is a financial investment. It's a financial investment which are broadly categorized into four. So let's look at types of financial assets or classification of financial assets. One, we have financial asset at fair value. Number two, we have available for sale financial asset. Number three, loan and receivables. And then number four, we have held to maturity. Those are the four broad categories of financial asset. But mostly I want to focus on the first two, the financial asset at fair value and available for sale. So what's the difference? So let's start with number one, financial asset at fair value. So now, financial asset at fair value, they are short-term investments. So this is a short-term financial investment. This is a short-term financial investment. And since it's a short-term, another characteristic is that since it's a short-term, that means therefore it's part of current assets. So it's a current asset. And another characteristic is that for the financial asset at fair value, is that it's measured or valued at fair value. And when you talk about fair value means the market value. So that's financial asset. Then number two, we have available for sale financial assets. And available for sale, this is a long-term. This is a long-term financial investment. That means it's taking more than one economic period. Therefore, since it's a long-term financial asset, another characteristic that means therefore it's an uncurrent asset. It's an uncurrent asset. And then It's measured or valued either at amortized cost, or at fair value. That's how we measure available for sale, either at amortized cost or at fair value. Good. So that means we are measuring them financial instrument. A financial instrument can either be measured either at fair value or at amortized cost. Good. So now let's look at what we call the recognition of financial statement. So at the recognition, when you talk about recognition, this is why you are recognizing a financial instrument or a financial asset in the financial statement. But when you talk about the recognition, what's the recognition? Now, the recognition of financial instrument or financial asset, this is where a financial asset or financial instrument which has been previously recognized in the financial statement is now being removed from the financial statement. That's what we call the recognition. And what are some of the circumstances which may lead to the recognition of financial instrument? So what do you think? Can make an asset to be removed from the financial statement and being removed from financial statement? An item can be removed or might be removed from financial statement. What do you think are those circumstances? So try to think on that. And number one is when disposal of that asset. If you dispose an asset, the financial asset, that means the asset will be recognized from financial statement. That's number one, disposal. Then number two, when that financial asset has been fully impaired or has been fully depreciated. So when an asset has been fully depreciated, that means in that case, you recognize it from the financial statement. And those are some of the circumstances in which a financial instrument need to be recognized. Good. Or when the asset is being sold. Yeah, when the ownership has been transferred. Good. How do we account for that? Or let's look at what are some of the indicators of impairment of financial instrument. Earlier we have looked at the topic known as impairment. At the impairment, an asset is said to be impaired if the carrying amount exceeds the recoverable amount. Sometimes also financial instrument can be impaired. And what are those indicators? So let's look at the indicators of impairment loss of financial assets. So what are those indicators? Number one, disappearance of an active market for the financial instrument. Then, number two, when there is significant financial difficulty by the borrower. In this case, assuming the borrower has borrowed some cash from you, and in this case, they are facing financial difficulties. So that means they cannot be able to refinance that loan. So in that case, it's one of the indicators that financial instrument has been impaired. Number three, when there is a breach of contract, such as default in payment of interest, of either interest or principal. Yeah, assuming for this financial instrument, or maybe assuming it's a loan, and the borrower has been paying interest, but there is reached a time that for 2 months or 3 months has not been able to finance that debt. So in that case, we may say that it's one of the indicators of an impairment loss of a financial asset. And mostly when the financial assets are issued, for example, assuming you are issuing a debt, a debenture, or a bond, we'll be coming across two rates, some of the terminology. One, we have what we call the coupon rate, and we have what we call effective rate. And what's the difference between the two? Now, coupon rate or the coupon interest rate is the rate agreed at the date of issue of that financial instrument. So this is the rate at the date of issue or at the date of the agreement. But effective rate is the same as the current market rate. Current market rate. Now assume at the date when you enter into a contract for a debenture, you agreed at a rate of 6%. But the current market rate, maybe after 2 years or 3 years, and the prevailing market rate is 8%. So this 6%, this is what now we call the coupon rate. And the 8% is the effective rate. And the difference is that the 6%, you financing the debt, remember you agreed you'll be paying 6%. Now this 6%, you'll be paying 6% of the principal or the par value. This is what you should either be paying or receiving, depending on whether it's an asset, a financial asset, or financial liability. It's 6% of the par value. Then the 8%, to leverage the two between the coupon rate and the effective rate, that's when we say that the debt needs to be amortized. And I'll come to show you how do we amortize the financial instrument. So with that, I want us to do an illustration. We do an illustration from the handout. For those with the handout, take out your handout, go to page number 2. Page number 2, I have indicated a topic, financial instrument. We do question number 1. So let's do that question. Question number 1, that's handout page 2. Illustration number 1 when you have financial instrument. And you are told that on 1st January 2012, Mark Limited purchased a debt instrument at its fair value of 1,000. That's the fair value. Purchase the debt at a fair value. Remember, fair value is the market value of 1,000 Kenyan shillings. The debt instrument is due to mature on that 1st December 2016. So from 1st January 2012 to that 1st December 2016, that's a duration of 5 years. Interest on debt instrument is at the rate of 4.72 coupon rate. So we are given a coupon rate of 4.72. That's what we are told. That interest on debt instruments is the rate of 4.72 coupon rate that's payable at the end of each year. The instrument has a principal amount or the par value. So the par value of this debt is 1250. 1250 payable on maturity. So this now that means is a financial instrument payable on maturity. Then you're told that the effective interest rate is 10%. Effective rate, you're told, is 10%. Required. How should Mark account for the debt instrument? How should Mark account for this debt instrument? So number 1, you have to ask yourself. We have said that a financial instrument can either be financial asset or can be financial liability. So in this case, you need to ask yourself, is it a financial asset? Is it a financial liability? So let's read again. On 1st January 2012, Mark Limited purchased a debt instrument. So in this case, Mark purchased a debt instrument. So to Mark, is it an asset? Is it a liability? If you purchase a debt instrument, that means this becomes an asset to you. If the company issues debenture and you buy the debenture, you become the debenture holder. That means to you it's an asset because you expect to receive the interest. But if you issue that debt instrument, you, the issuer, it becomes a liability to you because in this case you'll be paying the finance cost. So in this case, to Mark, this one is a financial asset because he purchased. So how do we account for this? You see, in this case we have the coupon rate and we have the effective rate. So how do we amortize? So we amortize. So let's present amortization schedule. And this is how we prepare the amortization schedule. So we have period. The debt was issued on 1st January 2012. So we have 2012, it's mature in 2016, 2013, 2014, 2015, and 2016. Then we determine balance brought down. Then, to him we have said that it's a financial asset. So therefore we determine the interest income. If it was a liability, you could have shown interest expense. So that's why you're saying it's very important to determine whether it's an asset or liability. And then you determine the cash flows. And then you get your balance carried down. What does that mean? So you need to note that the interest income or the interest expense should be based on the effective or the market rate. But cash flow, this amount you're supposed to receive or to pay at the end of each period, and should be the same amount. The cash flow is based on the coupon rate, and that one does not change. So like for example, in this case, we are told that the coupon rate was 4.72%. That was the rate you agreed at the date of issue. And then how much is the par value? You usually pay that based on the par value, and the par value was 12.50. That means at the end of each year, you're supposed to be paying 59. So in phase, you'll be receiving 59, 59, 59, 59, 59. That one does not change. But the interest income will be based on the effective rate or the market rate. And we are told that the effective rate is 10%. So how do we amortize that? So we are told that on 1st January 2012, Mark purchased a debt instrument as its fair value of 1,000. So, as at 1st January 2012, the fair value of the debt instrument was 1,000. And we are told that it will mature at 2016 at its par value, and par value was an amount of 12.50. That's what we are told. Let me read that statement again. We are told that, the instrument has a principal amount, that's par value, of 12.50 payable on maturity. So that means it will be paid on maturity, and it will mature on 2016. So the balance carried down as 2016 should be 12.50. So how do you amortize that? From 1,000 to 12.50. Now this is what you do. It's 1,000. The interest based on the market rate, remember the effective rate was 10%. So you take 10% of 100, of 1,000 is 100. This is what you are supposed to receive currently. But you already received what you agreed, which was 59. So much is the balance carried down. This is what you do. Balance brought down at 1,000. You are supposed to receive 100, but you have only received 59. That's what you have received. So how much will be the balance carried down? So it's 100, it's 1,000 plus 100, and then you minus 59, and you get an amount of 1041. Now the balance carried down becomes the balance brought down. 1041. Interest at 10%, that one is approximately 104. So you take 1041 plus 10% of 1041 is approximately 104. It's 1041, you add 104, but you have already received 59. So how much will be the balance carried down? We have a balance of 1086. So 1086, the balance carried down becomes the balance, the opening balance. 1086. 10% to get the interest income is 10% of 1086. So let's just call it 109. So it's 1086, and then you're supposed to earn the market interest of 109, but you had already received 59. So you deduct what you have already received. So how much will be the remaining balance? So it's 1086 plus 109 minus 59. You have a balance of 1136. Then 1136, 10% of that is approximately 113, sorry. So it will be 1136 plus 113 minus 59. You get an amount of 1190. Then you open with 1190. 10% of this is approximately 119. 1190 plus 119 minus 59. You are supposed to get 1250. That's how you amortize. So that means the interest income based on the market rate. This is what Mark should take to the income statement as part of other incomes. The interest income should be shown to the income statement as part of other incomes. And then balance carried down, the balance carried down, this is what now need to be presented to the statement of financial position. And this one, since it's a long term, now this is what we call available for sale. Because number one, this is a long term, it's taking 5 years. So that means to the non-current assets, you should represent a financial asset which is available for sale. That's how Mark should account for that question. So look at that. And then another thing, sometime the examiner can only give you the par value. Remember, the par value is what you agreed of the principal amount. And you are not given the fair value. How do you determine the fair value? Because in this case, you need to get the fair value and the par value. You may be given the par value, but how do they determine that the fair value or the market value was 1,000? Now, this is what you usually do. This is what you usually do. To get that 1,000, this is what you do. To get the fair value, you just take present value of annuity plus present value of maturity value. You take the present value of the annuity. Remember, in this case, your annuity is the cash flow. This is what you are supposed to be receiving at the end of the year, which is the same amount, 59 up to the end. So that was the interest. So to get this of annuity, you just take the coupon rate, 4.72 times the par value 1250. That means in each year they are supposed to be receiving 59. So to get the present value of annuity, you take 59 times, to discount present value interest factor of an annuity. The market rate or the effective rate is 10%. 10% for the next 5 years plus present value of maturity value. The debt always mature at its par value. So when they are at the end of year 2016, you will get your value back of 1250. So the maturity value will be 1250, but you get its present value. So present value interest factor, this one is not an annuity because you'll only receive one at the end of year 5. 10%, that's the market rate after 5 years. So it will be 59 times, this is an annuity. When using annuity, it's 1 minus 1 plus R. Our R is 10%, 0.1, raised to power n, negative 5, raised to power negative n. And then you divide by R, 0.1. And then you add 1250 times, how do you get the present value of a single amount? It's 1 plus R raised to power negative n. So it's 1 plus R, 0.1, that's our rate, raised to power n. Our n was 5 years. And that's how you determine 1,000. The 1,000 which you are given there. In case you are not given, that's how you can determine that. So look at that question. So let's do another illustration. Let's do question 2. Question 2 of that handout. Question 2. And question 2, you are told that Summit Limited issued a bond of 503,778. They issued a bond. So you ask yourself, to Summit, is it an asset? Is it a liability? They issued a bond. So if they issued a bond, so to them it's a liability. So Summit Limited issued a bond for 503,778 on 1st January 2014. No interest is payable on bond, but it will be held to maturity and redeemed on that 1st December for 6008. So what does that mean? So it was issued at 503,778. That was on 1st January 2014. Then you are told that no interest is payable. So that means in this case there is not that aspect of annuity. But it will be held to maturity and redeemed on that 1st December 2016. That 1st December 2016. So that's after 3 years. For 600008. So this the amount they were issued, and it will be redeemed at 6008 after 3 years. Required. Calculate the finance charge. Now the finance charge is the same as the interest expense. Interest expense and the carrying amount of the bond till maturity and the carrying amount. So how do you amortize this? So in this case, you'll be preparing this amortization schedule. So amortization schedule, this is how you'll be presenting. So you have period. We have 2014, 2015 and 2016. It was for 3 years. Then you determine balance brought down. Then we have seen that they issued. So if they issued, that means in this case they will be presenting not interest income but interest expense. So you determine your interest expense. And then you have been told that no interest is payable. Yeah, we are told that No interest is payable, but the bond will be held to maturity. So in this case, there is no that amount of cash flow. You only now show the balance carried down. Now, for the interest expense, we say that it will be based on the market rate or the effective rate, of which you are not given the rate. But since we are not paying any interest at the end of the year, it will be held to maturity. So how do we present that interest expense? So it's very easy. The amount was issued on 1st 2014 at 503,778. This amount will be held to maturity and mature at that 1st December 2016, and it will mature at 600,008. So can you see the transition from 503 to 608? So that amount of interest, how do we determine that amount of interest? This is how we determine. So let me take you back to financial management. Future value is equals to amount 1 plus R raised to power n. That's how you get to the future value. Or you can get, how do you get present value? To get the present value is just the amount 1 plus R raised to power negative n. As simple as that. So, but let me use the first one. So future value, the future value will be the amount which will be mature at year 2016. So in this case, it's 600,008. So my motive of using this, I want to determine the rate, the interest rate, is equals to the current amount, which is 503,778, 1 plus R. R is unknown. That's what we are looking the rate. But it will be after 3 years. So can you be able to get R? Yes. So you divide both sides by 503,778, 503,778. That one and that one goes. So 1 plus R raised to power 3 is equals to this. So 608,008 divided by 503, all that. So what do you get? So you get 1.06. 1.06. Sorry, not 1.06. So that's 608. You divide by that. Yeah, you'll find it's 1.19. So to get R, you have this cube root. So what do? You get the cube root. Cube root on both sides. So you'll have 1 plus R is equals to 1.06. So to get your R, you take this to the other side. So it will be 1.06 minus 1, and you'll find your rate will be 6%. So that means our effective market rate or our interest rate will be 6%. Now, after you have that, now you can be able to present. So that means your interest expense is 6%. So the balance brought down is 543,778. 6% of that, the interest will be an amount of 30,227. So you take 543,778, you add that to get the balance carried down. You have an amount of 534,005. And then the closing balance becomes the opening balance. So you have 534,005. To get the interest, you just take 6% of the balance brought down. You have an amount of that 2,040. To get the balance carried down, you take 534,005. You add the interest of that 2,040. You have an amount of 566,045. So the closing balance becomes the opening balance, 566,045. You get the interest, 6% of this, have an amount of 33,963. So that you add that, you should get 600,008. So that's how you are supposed to amortize. So that means the interest expense, this is what you should take to the income statement as part of expenses. This is an interest expense. And then to the statement of financial position, this is what you take to the statement of financial position. But in this case, you show this is the carrying amount. They represented as a liability. This is a liability and this is an expense. The one we have previously done, it was supposed to be an income and the other one was supposed to be an asset. This is an expense and this is a liability. So as simple as that. So let's do another question. May 2018, question 4A. May 2018, question 4A. That's from the past paper. Let me read the question. And we are told that E Limited issued a bond. So if they issued a bond, that means to them it's a liability. issued a bond for 200 million on 1st January 2018. Interest on bond is payable in arrears on that 1st December each year at the rate of 12% per annum. So that's what we call the coupon rate. They are paying at 12% at the end of each year. So that means an annuity, and that means therefore it's a coupon rate. The bond will be held to maturity and redeemed on that 1st December 2020 for 258.24. So you're given even the maturity value. The effective rate is 20% per annum. You are given the effective rate. The bond has not been resignated its fair value through profit and loss. Required. Charge to the income statement for each of the 2 years, 2018 and 2019. But we can just present for for all the 3 years. And then number 2, extract of the statement of financial position. So in short, you need to amortize so that you can determine what do we take to the income statement, what do you take to the statement of financial position. So we present our amortization schedule. Amortization schedule. So we are doing May 2018, question 4A. So we have period. It was issued in 2018. It's mature 2020. So we have balance brought down. Then they issued. If they issued the bond, so that means to them it's a liability. So we'll be having interest expense. And then we have cash flows. In this case, we are given the coupon rate so that we can determine the balance carried down. So the coupon rate was 12%. That's what they pay at the end of each year. So cash flow will be 12%. And then we are told that E Limited issued a bond for 200 million. So they issued 200 million as at 1st January 2018. So the balance brought down is 200 million. Then we are told that the bond will be held to maturity and redeemed on that 1st December 2020 for 258. 2020, the balance carried down will be redeemed at 258.24. The effective interest rate is 20%. So to get the interest expense, you take the effective rate, which is 20%. So how do you amortize that? From 200 to 258.24. So it's very easy. It's very easy. We see that cash flow does not change. How much did we issue? We issued 200. So you just take 12% of 200 so that we can determine how much amount will we paying at the end of each year. And 12% of 200 be an amount of 24. So that means all the year will be paying 24, 24, 24. Cash flow does not change. But for the interest expense or the effective rate, that means it's based on the market value. It keep on changing based on the balance brought down. So you take 20% of 200, which is 40. So how do we get the balance carried down? The balance was 200. The interest, the market interest rate you are supposed to pay is 40. So it's 200 plus 40. You get 240. But you have already paid to 24 because that was the original agreement. You have already paid 24. So how much will be the balance carried down? And you find an amount of 216. Then the balance carried down becomes the opening balance, 216. 20% of 216 will be 43.2. So it's 216 plus 43.2. You deduct what you have already paid, 24. So the balance carried down will be 235.2. And then the balance carried down, that's 235.2. 20% of that will be an amount of 47.04. And then you rest 24. So if you take 235.2, you add 47.04, you deduct 24, you should get 258.24. And that's what you are given. So what do we take to the income statement? Now let me show you how to take to the income statement. To the income statement, you have year 2018, 2019, and 2020. This is how you are supposed to present. This was a liability because they issued. If they issued, that one becomes liability. So under the expenses, you show the interest expense. And interest expense for year 2018 is 40. 2019 it's 43.2. And here we have it's 47.04. That's what we require, number one. Number two, you are supposed to show that. Number two, what was the required? Extract of the statement of financial position. So, statement of financial position. The statement of financial position. So, we have here 2018, 2019, and 2020. So, to them, it's a liability. So, you'll go to the non-current liability. Non-current liabilities. And they had a bond. Remember, it was bond, because we are told that E Limited issued a bond for 200 million. So, it's a bond. So, 2018. So, let's go back there. To the balance carried down, what do they represent? So, in year 2018, we have is 216. 2019 is 235.2. And here we have 258.24. So let's try the last question. We'll try a last question. Open with me December 2010. December 2010 question 2. December 2010 question 2. Yeah, question 2, we do part A and part B. Question 2, A and B. So, hoping we are there. So, part A, we are told that briefly explain any 3 factors that might indicate the financial asset is impaired. That might indicate financial asset is impaired. So, kindly don't confuse. Under the topic of impairment, there is indicators of impairment loss of an asset. But in this case, they have specified indicators of impairment loss of financial asset. And we say that what are those indicators? Number 1 was disappearance of an active market for the financial instrument. And number 2, financial difficulties by the borrower or the issuer. And number 3, when there is a breach of contract, such as default in payment of the interest or the principal amount. So that's number A. Part B of the question. Part B. Redline Limited invested in 10% loan stock. If they invested, that means to them it's an asset. On 1st November 2007. Given a par value of 20 million. So the par value was 20 million. So the par value of this debt was 20 M. The issuer of the loan was Borrow Limited. So Borrow is the one who issued that bond, and then Redline purchased. The loan was for 5 years. So period was for 5 years. For 5 years, and was to be settled on that 1st October 2012. Then you are told that the loan stock was quoted, but Redline Limited was to hold it to maturity. The effective interest rate on 1st November 2007 was 12%. The effective rate as at 1st November 2017 was 12%. And this had not changed over 3 years to that 1st October 2010. Has not changed for 3 years. On that 1st October 2010, that's after 3 years, Borrow Limited, now the borrower was the issuer, after paying the annual interest, went into financial difficulties. And Redline Limited estimated that the interest would be received over the remaining 2 years, but only half of the loans will be received on maturity. The loan stock was therefore impaired. So in this case, they are testing the impairment. So required, explain how the loan in Borrow Limited will be reported by Redline Limited. So how much was the coupon rate? Part B, again, we are told that Redline Limited invested in 10% loan stock. That means that 10% was the coupon rate. That was the rate at the date of an agreement. And the par value was 20 million. So in this case, you are not given the fair value. How do we get the fair value? We say that to get the fair value, first of all, I need to amortize. To get the fair value, you take present value of an annuity plus present value of maturity value. So we start with the annuity. We say that the annuity is the interest you'll be paying at the end of each year. And that interest, so let's compute that interest. You take the coupon rate. At the date of issue, you agreed you'll be paying 10%. So you'll take 10%, that's the coupon rate, you multiply by the par value, and the par value was 20 million. So that means you'll be paying an interest of 2 million each year. So to discount that to get the present value of an annuity, you'll do this. Is 2 million times present value interest factor of an annuity. Cost of capital, you use the effective of the market rate, which is 12%. 12%, and it was for 5 years. Plus present value of the maturity value. Those long-term debt always mature at their par value, and the par value was 20. So you expect to receive back your 20 million after 5 years. So you take 20 times present value interest factor, it's not an annuity, 12% for 5 years. So what will you get? So this is 2 times, how do we get the present value? So to get the present value of an annuity, it's 1 minus 1 plus r raised power negative n over r. So it will be 1 minus 1 plus our r is 12%, 0.12 raised power negative n, which is 5 years. You divide by r, and r is 0.12. You add 20m, you multiply by, how do we get the present value of a single amount? It's just 1 plus r raised power negative n. So it will be 1 plus 0.12 negative 5, like that. And I'll get an amount of 18.56. You get 18.56. So now let's amortize that. Now we can present amortization schedule. So we have period, and it was issued 208 for the next 5 years. Then we have our balance brought down. Then we have interest income. Remember, we invested. They are the one invested, so that means they purchased. And then we'll have our cash flows. And we say the interest income will be based on the market rate. And the market rate or the effective rate was 12%. And the cash flow will be based on the coupon rate. And coupon rate was 10%. And then we can be able to determine our balance carried down. So our shilling, remember, they are, okay, let's put them in thousands. Our shillings in thousands. So that means the fair value of the market value is 18.56 million. So which is equivalent to, if you put your figures in thousand, it will be 18,560. Interest income is 12% of 18,560. You have an amount of 2227. Cash flow does not change. It's 10% of the par value. And I already computed it. 10% of 20 million was 2 million. So that means each year, and that one does not change. Each year you'll be receiving 2. That's what you are receiving, because to them it's an asset. So let's get the balance carried down. It's 18,560. You add 2227 minus 2,000, and you have an amount of 18,787. The balance carried down becomes our opening balance. So 18,787. Interest rate is 12%. Times that, you'll have an amount of 2254. That plus that minus 2,000, you'll have an amount of 19,041. 19,041. 12% of this will be an amount of 2285. So you take 19,041, you add that, you deduct 2,000, you have an amount of 19,326. First of all, to achieve Apple. That was the third year. Let's go back to the question. We'll go back to the question. We were told that on that 1st October, that's the second paragraph. Let's go back to the second paragraph. On that 1st October, that's at the end of the third year. Borrow Limited, who was the issuer, after paying annual interest, went into financial difficulties. And Redline Limited, estimate that the interest will be received over the remaining 2 years. The interest over the remaining 2 years, they receive that interest. The interest will not change. The interest will not change. We receive the interest over the remaining 2 years, but only half of their own stock would be received on maturity. But only half of their own stock will receive on maturity. On maturity, remember, you are supposed to receive our par value, which was 20 million. So on maturity, you only receive half of it. So that means on maturity, we will only receive 10 million. So, therefore, you are told that their own stock was therefore impaired. Their own stock was therefore impaired. So now the question is, explain how a loan from stock or loan in Borrow Limited will be reported by Redline Limited in the financial statement for the year that 1st October 2010. So, you see in this case there was an impairment. You are supposed to receive 20, but in this case you estimate that you only receive half of it. So, and it was impaired at the end of year 3. So what do we do to get our opening balance here? To get our opening balance here, you use the formula again. To get the fair value, you'll do this. You take the present value of an annuity, of which annuity you'll receive the 2 million for the remaining 2 years. So you'll take 2 million for the next 2 years. So it will be 1 minus 1 plus R 0.12 raised by negative 2, the remaining 2 years. You divide by 0.12 plus present value of the maturity value. Maturity, you will not receive now 20 million. You will only receive 10 million. 1 plus R 0.12 for the remaining next 2 years, negative 2. So how much do you get as your present value to get your opening balance? So in that case, you'll have a value of 11,352. 11,352. So has it impaired? Now let's look at this. The closing balance was 19,326. But after we have taken into consideration the amount we expect to receive, it has gone down to 11,352. So you can see there is a reduction. That reduction is what we call impairment. So that means our impairment rose, the balance was supposed to be 19,326. But the current value after adjustment is 11,352. So that means our loan was impaired by how much? Our loan was impaired by an amount of 79.74. 79. This one, you take it to the income statement as an expense. That's an impairment. So how do we account for it? So now, this is what happened. 2011, the balance brought down, it will not be 19. Remember, the closing becomes the opening. In this case, remember, it has been impaired. So you will do 19,326, you minus the impairment, and it will remain with 11,352. That's the fair value now. So it will be 11,352, and then the analysis continues. 11,352, interest is 12% of this, and 12% of that you have is 1362. So it's 11,352, you add 1362 minus 2,000, and you have a value of 10,714. Then 10,714, interest is 12%. 12% of this you have is an amount of 1286. So 1286 plus 10,714, you minus the 2,000, you should get 10,000. You get 10,000. Good. As simple as that. So look at that so that I can show you how will they present in the income statement. So this is how they present the income statement. So income statement. So we have here 208, 209, 2010, 2011, and 2012. So that's so small. I'll show it here. So to the income statement, so you have here 208, 209, 2010, 2011, and 2012. So how will they present that? So remember, to them it was an asset. So if it was an asset, you show the interest income. So now let's be here. This. We say that the interest income is what we present to the income statement. So the first year, 208 will be 2227, 2254, 2285, 1362, and 1286. Then under the expenses, you have to indicate expenses. There was an impairment loss. And the impairment, remember, it occurred at the end of the third year. And how much was the impairment? Impairment was 79.74. That's how they show. Yeah, this is the impairment. This is what you take now to the income statement. Good. So now how will they present the statement of financial position? That's the balance sheet. So to the statement of financial position, this is how they present. So you have 208, 209, 2010, 2011, and 2012. So we start with the assets. That's non-current assets. To the non-current assets, so we say that this instrument it's a long term. You see, it's for 5 years. So that means it's available for sale. So this is how we present. 208, the balance carried down. What you got here from amortization schedule as the balance carried down is what you show to the statement of financial position. 208, we had 18,787. 209 was 19,041. 2010, this is where we had the impairment. So you'll do this. It's 19,326. You deduct the impairment. And the impairment was 79.74. And if you deduct that, you'll get this amount, which was the carrying amount, which is 11,352. So 2010 will not show 19. You'll show now 11,352. 11,352 after taking into consideration the impairment. Then 2011, we just continue. 2011, we had 10,714. And there we have 10,000. So that's how you present that question. Good. So now with that, that's all about financial instrument. That's all about financial instrument. And financial instrument is not a must. It has to be tested as a separate question. It can come as a question in another question, mostly when presenting the published financial statements. So, and that marks the end of that session for financial instrument. So thank you for your time.